In this video, we're going to talk about the concepts of return and risk. Both elements are very important in the financial decision-making models and process. So the concept of return, basically, it's just a level, right? It's a profit number. There are certain parts, obviously, to the returns that you can receive. And really, you can get two kinds of returns. You can get income forms of return, that is, cash is actually paid, or you can also get capital gains or losses, which is when you have gotten to the end of the time of owning this asset. When you sell the asset, you will receive either a profit or a loss on that sale. So the total return of an investment is the sum of both its income returns and its capital gain returns. You have two investments here, both of them cost $1,000. They have different types of cash flows during the investment period, and of course they have ending prices. So how do we determine the value or the total returns? So for this particular investment, right, the income was $80 for asset A. The capital gain was $100. Started off at $1,000, we sold it for $1,100. So the total return was $1,180. We'll talk about how we calculate this return in a little bit. For asset B, it has higher income cash flows, but it has a capital loss. So the total return on B is $80. So why is return so important? Well, quite frankly, it's just the way we keep score, right? I mean, this is how we know whether or not an investment is performing the way we want it to perform. The higher the rate of return, obviously the more rapidly we can increase our wealth and get to whatever financial goals we may want to achieve. Historical performance is going to be a basis. That's where we're going to start most of the time, because this provides a basis for future expectations. Now, what every financial document says about returns is that past performance does not guarantee future performance. So it gives us a basis, but now we also have to adjust it, given some information or data that we gather, and we will analyze what we think is going to happen moving forward. So moving forward, the expected return is what we think we're going to receive if we were to purchase this asset. So we're going to utilize this expectations to ultimately determine what are you willing to pay to buy the asset, right? How much is the asset worth to you? With respect to returns, there are lots of elements, if you will, that will affect the returns of the asset. And these factors, if you will, are really all risk factors, right? There are internal characteristics, right? It's the type of investment has certain risk characteristics. The quality of management, the amount of debt that the company utilizes. And then there's external forces from politics, business, right? The economic environment, right? Inflation. All of these things will have an impact on the level of return that an asset ultimately receives. Now, just as a picture, I just want to take a second to say that this particular graph shows rates of returns on different kinds of asset classes. Now, this only goes to 2014, but the numbers have stayed relatively the same. And if you look, we can find out here's stocks, long-term government bonds and short-term government bonds. And we also have the inflation rates for these countries. So if you look at the United States, stocks was 9.6% and inflation was 2.9%. So the real return here was roughly 6.7% is what the real return of stocks was from 1900 to 2014. If you look at some other countries, it appears here that Finland has the highest return, 12.9%, but they also have a 7.1% inflation rate. So their risk premium, if you will, or excess return, is 5.8%. Certainly a little bit less than the United States. Here's 11.2 for Japan, 6.8. So you subtract those out, we end up with something like 4.4%. So it's not just the return that's important. We also have to understand how inflation, how the cost of money changes, and it certainly changes differently in each country. I did a little bit of an excerpt, a little bit of a research not too long ago, and I just gathered some returns for the S&P composite return, the Russell 3000 index, and the Wilshire 5000 index. And what we find is from 1979 to 2011, it's 32 and a half years. Now, if you also remember what happened in 2008, 9, and 10, we had a huge recession in the United States. So during that time frame, that's included in here, 32 and a half years. The S&P 500 stock market index averaged around 11.1%. The Russell 3000, 12.4, and the Wilshire 5000, 11.9. So this is obviously a very long time frame, 1900 to 2014. I'm not sure what stocks they used to do this calculation. This is just a picture of this particular time frame and these stock indexes. We'll talk about indexes in a later video. So the time value of money is obviously very important. The sooner you receive a return, the better off you are, the more certain it is. $1 received today is worth more than $1 that you get in the future. And of course, the sooner you can begin earning money, the faster it will grow. We could kind of refer to these as the 3 golden rules, right? You want to get your money back sooner rather than later. The longer your money is invested, the longer it is out somewhere, it loses value. So you have to earn a return that is going to beat that dollar loss. And finally, the sooner you can start investing, the better off you will be. Now, there's lots of ways that you can calculate the time value of money issues, and we'll talk about some of those, but certainly you can use financial calculators and electronic spreadsheets are the easiest way because they have formulas that you basically plug in data and it will calculate the value that you're looking for. So another topic here, and again, these are all sort of tied together, is what is the definition of a satisfactory investment, right? It's an investment. It's one where the present value of the benefits that you think you're going to receive are equal to or exceed the present value of its costs. So if the present value of the benefits exceed its cost, you're going to get a rate of return greater than the discount rate or the rate that you wanted. So these are the kinds of investments we really want to find. Those that have benefits that exceed costs. If the value or the benefits equal the cost, you're going to get the discount rate, which is the return that you required. So we ultimately end up with a couple of investment rules here. If the value of an asset is greater than or equal to its market value, that is, if its benefit is greater than or equal to its cost, you want to buy the asset. This is going to create an increase in wealth for the owner. If the internal rate of return is greater than or equal to your required return, again, you would want to purchase this asset. That means that it's going to give you a return that is more than what you wanted or what you required of the investment. And that rule will follow throughout the whole course. It's the basic rule of investing in general. So there are several measures that are going to help us compare alternative investments. So we want to be able to incorporate some time value of money issues, and certainly we'll cover some of those in this and the next chapter or the next video. So first we have a definition of what's called the nominal rate of return. This is the rate of return expressed in current dollars. It does not take into account the effects of inflation. The real rate of return is a measure that looks at, essentially it's a measure of the supply and demand of money, right? It measures the increase in purchasing power that an investment provides. So the definition, the real return, is approximately the nominal return, whatever you've earned, minus the inflation rate. So let's continue with this discussion of rates of returns. Investors are generally risk averse. They don't like risk, and they'll only take risk if they expect compensation. And I think that's a little bit strong. I don't want to say that they don't like risk. Risk averse investors recognize risk, and when they see risk, they will only invest if they're going to be compensated for taking those risks. So the required return is the rate of return that fully compensates an investor for the investment's risk. So the required return on an investment is the real rate plus inflation plus a risk premium. So the real rate is the rate of return that's created by the supply and demand of money. I think the inflation premium is pretty self-explanatory. And then the risk premium itself are the risks that come from the type of security, the company itself. All of those things are incorporated in this risk premium, if you will. So we can break this down into some easier components. So this expected inflation premium is what the inflation is expected to be over the investment's life. Now this will be different for almost any kind of investment you can think of. Is the inflation impact going to be the same for a 1-year investment as it would be for a 12-year investment? And the answer is obviously no. So we can create what's referred to as the risk-free return, which is the real rate. Again, that's created by supply and demand of money, plus the inflation premium. Now, again, this inflation premium is dependent on the asset's life, etc. So this risk-free rate is a very important starting point for any kind of investment. Typically, we're going to use a United States Treasury security as our proxy for this, right? We don't have a good way to really measure this, so we come up with something that is, for all intents and purposes, completely risk-free, and that's a United States government bond. The risk premium, again, is attached to this risk-free rate and is dependent on the company and the security. So the type of security, the maturity, the features that are available, the issuer characteristics like the industry and company factors, all of these are incorporated in this risk premium. So the required rate of return on any investment is the risk-free rate of that kind of investment plus the risk premiums. So one way we can calculate returns is through something called the holding period return. The holding period is just the time frame over which you want to have this investment. So we need to understand a little bit about the return components, right? There are really two kinds of returns. There's something that's referred to as the realized return. This is the income that's received during the investment period. Now the paper return is the capital gain or loss that's been achieved but not yet realized. So what's the difference between these? Realized returns is something you actually receive. Paper return only is calculated or is only realized when a sale takes place. So you have to sell the asset to ultimately turn a paper return into a realized return. So the holding period return is a calculation. And again, this is an algebraic equivalent to what might be in your textbook. It's just a little bit easier to talk about. But the holding period return, you take the cash flows during the time frame. This is for a 1-year period. Add the price at the end of the period and divide that by the price at the beginning of the period. And then you subtract that from 1. That gives you a decimal, which obviously then you multiply by 100 to get percent. Now the challenge with this formula is that it's only for 1 year or less. So what happens if you have multiple holding periods? We may want to annualize. What does annualize mean? Annualize means to convert this so that it looks like the rate of return you earn per period. So in this case, you see the formula is really the same, except now we have an exponent. And this 1 divided by n exponent is the number of years in the holding period. And again, subtract that from 1, multiply by 100 gives you percentages. So here are 4 examples, if you will. Here is an investment. We started off at $2,000. We'll do the common stock, right? The ending value is $2,200. So we have a $200 capital gain. And over this time frame, we earned $45. So the investment time was a year. So in this case, the return is 12.25. And of course, the holding period return is also 12.25 because it's a 1-year holding period. Likewise, if you look at the investment, I'm trying to see the investment in bonds, we'll see that actually the ending value was less than the beginning value. We have a capital loss, but we had positive cash flows, more cash flows than what the investment cash flows were for the stocks. So we ended up with an 11% rate of return. So the question we have is, what would happen if you held this, if this investment happened not in 1 year, but what if it happened over 3 years? How would that impact then the investment, if you will, the investment return? Of course, we'd have to maybe change the cash flows so that the cash flows reflected each year, or we could just say this is what it earned over the 3-year window, but you change the investment time to 1. So let's assume all the numbers stayed the same except we change investment time from 1 to 3. Well, you're going to get 12.25%, but you get that spread over 3 years. So the return is actually per year on a time value basis. The annualized return will be less than 12.25 because you earned it over a longer period of time. And likewise, what if you earned this over a half a year? Then you would put in here 0.5. Again, you got 12.25 is the actual return, but when you annualize that, since you got that 12.25 in half of the time, the actual annualized return will be much higher. Now, the advantages of this holding period return idea is it's very easy to calculate and understand. It certainly considers income and growth. The basic holding period return doesn't consider time value of money, right? We take care of that issue when we use the exponent, when we annualize it. So that takes care of the time value of money issue. But again, since this is longer than 1 period possibly, we do have to now worry about the uncertainty of some of these events happening, or if it's what we expect to happen, or we just have to worry about the longer the time frame, the more possibly inaccurate the time period might be. So that is our first video on returns.